Ray Dalio is, of course, one of the largest, most popular investors in the stock market, with his investment firm Bridgewater Associates holding over $140 billion of assets under management. And it just so happens that they just now released their updated quarterly trades, which showed over $1 billion in recent stock purchases. So we're going to take a quick look today at the top 5 largest stock purchases that they recently made. And in typical All Is World fashion, I'm going to give you my own opinion on every single one of them, and I'll even rank them from best to worst based on my own opinion. So let's not waste any time, guys. I hope you enjoy the video, but let's go ahead and dive straight into this list of stocks that Ray Dalio has been buying. All right, and counting down here from smallest to largest, stock number 5 that Ray most recently purchased is the big bank Citigroup, ticker symbol C, which is actually a new addition to the portfolio this quarter after selling completely out of it the one prior, which you can see on that ownership history bar graph there on the right side. But what's interesting is that he now actually purchased even more shares than he used to own in all prior quarters, at over 1.2 million new shares added and worth close to $60 million. Now, the bet on a big bank like this isn't too surprising, considering that we are, of course, in a rising rate environment with one of the sharpest climbs in history. Here's a 10-year chart showing how fast we've gone from 0% interest rates up to almost 5% today in an effort to combat inflation. And while that certainly does raise the risk of damaging the economy and possibly sending us into a recession if you raise those rates too quickly, well, the fact of the matter is that banks still perform pretty well during a high interest rate environment, because they get to collect more money on the loans and debts that they issue out. And that's really the primary business of these banks, lots of loans and investments and things like that. As a result, though, Citigroup's net interest revenues climbed to a record high last year, reaching almost $49 billion, which is up from just around $42 billion the year prior. However, some banks are better run than others, and in my opinion, Citigroup is not at the very top, which is partially evident by other parts of their business still dragging them down and causing both their sales and profits to actually decline last year despite that record-breaking income on interest rates. To be fair though, a big part of that was actually due to the horrible performance of assets last year, like the stock market essentially crashing, coming off of the pandemic and stimulus-fueled boom, causing their investment sales and profits to crash right along with it. But even looking ahead, sales are only expected to bounce back slightly by about 3% this year and then still be flat the year after. So it's not like the performance is really picking back up yet. On top of that, Citi is also trying to revamp their business by doing a number of restructuring projects that may help them grow in the future, but in the meantime, are weighing heavily on their profits and even causing their EPS to decline by an average of almost 10% over the next 5 years, which is pretty freaking bad considering that it was barely even positive in the previous 5 to begin with. The upside to the stock though is that at least this poor performance has caused the price to fall by almost 40% from the top, and historically speaking, whenever it trades around these levels, it does tend to experience a significant rebound soon after. So we may be seeing the early stages of that kind of comeback in the stock right now, given that the valuation is 10 to 30% cheaper than the sector, while the dividend yield has also climbed up to almost 4% with a still very low payout ratio, and Ray may be trying to get in on that early while he can. The only drawback to the dividend though is that it hasn't been grown for the past 3 years, but at a 4% yield with a low payout ratio, it's at least pretty high already and gives you something to look forward to while you wait for the restructuring efforts to take shape. I'm not willing to wait around for that myself though, especially on the heels of a possible recession with a deteriorating economy where less people and businesses are willing to waste money, and thus they either take out less loans or even worse, they may actually default on them, which is something that can really destroy banks. Hence why bank stocks are a bit of a kind of like a risk reward balancing act at a time like this. Reward from the interest rates, but risk from the possible recession. I usually avoid buying them at times like this though, so I'll have to put Citigroup at the bottom for now at number 5 until I see what else is on this list. Okay, well, it's funny I should say that because stock number four is actually not only another bank stock, but it's actually the only one that I happen to own myself in my entire portfolio, and that is the banking giant JP Morgan Chase, ticker symbol JPM, which Ray had also been building up in prior quarters before deciding to sell out of it completely, only to buy right back into it this latest quarter and buy an even larger amount at close to $100 million worth of the stock. Unlike Citigroup, though, Chase has been a much more stable performer on not just their business, but also the stock price, which is still down a bit from the top, but at an 18% dip, that's not only about half the fall that Citigroup saw, but overall, JPM's trajectory has also been much more upright throughout its history when looking at the stock price performance. Financially, they also have much stronger performance as well. And while they did also see a small dip last year because of the crashing asset markets, it was still the second best year in the company's history. And moving forward, their sales are expected to climb by more than double the rate of Citigroup this year and like 4 times the rate next year as well, even though it's still pretty low. Unfortunately, their EPS is only expected to be about flat over the next 5 years, but even that is still much better than the negative almost 10% growth of Citi. Plus, JPM had already grown by a double-digit percentage in the previous 5 years as well. So I kind of see this as a very small kind of recession for bank stocks, maybe isolated to that could potentially get worse if the broader economy keeps deteriorating and goes into a bigger recession. But as it stands, Chase is by far the market leader with about a quarter of US total assets among banks and almost double the size of Citigroup, yet the stock trades only slightly higher than the sector, just a single-digit percentage on a GAAP basis. Plus, the dividend is also pretty attractive at close to a 3% yield with some excellent growth metrics on it, like a very low payout ratio, a double-digit growth rate, and over a decade of consecutive growth. Seeking Alpha is wrong about that number, by the way. I think it's like 12 or 13 years consecutive that they've grown the dividend. Anyway, Citi has a cheaper valuation and a larger dividend, but I think the slightly higher price tag for the more reliable performance is worth it in the case of JP Morgan, so I will rank them higher at number 4 for now and see what else is on here. Well, moving on to stock number 3, believe it or not, it's actually going to be yet another bank stock, this time in Bank of America, ticker symbol BAC, which after selling a small amount in the previous quarter, Ray has now more than doubled his position on it, bringing his total stake in the company up to over $106 million. And it's really starting to boggle my mind here why Ray is so bullish on bank stocks at a time like this. But to be honest, I have always felt that Bank of America is a pretty decent alternative to Chase if you're looking for one. They hold the second most market share just after Chase. Their financial performance has been very similar in recent years, with also about the same revenue growth expected over the next 2 years. And even their EPS is expected to average just a slightly positive growth rate, with the stock holding about the same valuation as the sector as well. Where things start to get less attractive than Chase, though, is in a stock that is a lot more choppy and currently down 30% from the top. That could be a good thing, but the choppiness is a little concerning. The dividend yield is also a bit lower at less than 2.5%, which isn't very attractive, although it does have some fantastic growth metrics on it. But on top of that, you should also keep in mind that one of the most common ways to measure a bank's profitability is by seeing how much profit it can generate from the assets that it holds. And when looking at the big banks, JP Morgan has consistently stood out as the leader with a higher ROA, return on asset, than the rest. So even though all three banks have similarities, I still have to give JPM the slight advantage for just being an all-around more reliable bank to invest in. And for that reason, I'll bump Chase up to number 3 and put Bank of America in its place at number 4 and keep Citigroup in last at number 5. All right, we are now down to the final 2 stocks though, and coming in at number 2 is actually going to be the giant investing company and conglomerate of the great Warren Buffett in Berkshire Hathaway, ticker symbol BRKB, which Ray increased his position on by 44%, bringing his total stake in the company up to over $111 million. And as much as I love the long-term investing mindset of Warren Buffett, I just have to admit that I've never been a huge fan of his company, as most most of their holdings tend to be a little boring, more kind of value oriented type of stocks that have a lot to do with finance, insurance, and oil and gas markets, with only, I would say, a few exceptions like Apple and Coca-Cola being two of the biggest holdings, but even Coca-Cola, I would argue, is a pretty boring stock as well. One of the main attractions to the stock, however, has always been their gigantic financials, doing over $350 billion just in 2021 alone, which was largely fueled by the stimulus-led stock market rally. However, that huge reliance on stock market investing, essentially acting like a hedge fund, caused them to subsequently take a huge hit the following year when the market crashed, sending their sales plummeting by over $100 billion down to $253 billion. That's almost a 30% crash in sales, at least according to Yahoo Finance here. Meanwhile, their free cash flow also fell to a multi-year low, and I can't even get a good idea of where they're headed in the future, as there is literally only one analyst on Yahoo Finance even covering the stock, which has also been one of the main reasons why I never like to track it, because it's so hard to get analyst coverage on it. I mean, on the bright side, that one single analyst does at least predict a 10% revenue climb from here, but I have no idea how accurate that is. Usually you'd have like 20, 30 analysts. You've only got one here, and it's going to be even more difficult to predict if we go into a recession, which would likely crush their investing profits as well. And even with all of that uncertainty, the stock still trades fairly close to a record high and is only down about 15% from the top, which doesn't make for a very cheap valuation. In fact, it's actually over 100% more expensive than the sector. I get why giant investors like to park their money in Berkshire, as it's a pretty safe bet because of its massive size, with currently over $100 billion just in cash and short-term investments alone, which it frequently uses to buy back its own stock, and it can invest in other things. And many times it actually buys back stock by billions of dollars per quarter, and that creates a lot of extra value for shareholders, which, by the way, it's even one of the top 10 largest holdings of BlackRock, which is the largest asset management company in the world. So clearly there's a reason to invest in it. But for smaller investors like you and me, I just think there's more exciting options out there. And because they don't even pay a dividend and carry a rich valuation, I'm going to rank them behind JP Morgan at number 3 and bump up Chase to number 2 to fit it in. I'll keep Berkshire ahead of Bank of America and Citigroup though, because of the massive size and notoriety and the reliability, and also just because I'm not a huge fan of bank stocks anyway. So I don't know, I'd rather diversify a little bit, go with Berkshire on top, ahead of those. Alright guys, that's going to leave us now though with the final largest purchase that Ray Dalio made most recently, and that stock is actually going to be an ETF in the iShares IVV ETF, which Ray has continuously purchased more and more shares of every quarter, adding another 305,000 shares this latest one, bringing his total stake in the ETF up to almost $800 million at over 4% of the entire portfolio. And if you're not familiar with this ETF, I actually recently talked about it in my BlackRock portfolio review video, because it's also one of BlackRock's largest holdings. But all it really is just an ETF that tracks the broader S&P 500, which, don't get me wrong, it's a safe place to park your money, but it's also relatively boring as an ETF to invest in. I mean, there are ETFs out there that try to give you more exposure to like artificial intelligence, big dividends, or maybe healthcare or some other type of sector. It's a great way to invest in different areas. But this one just flat out tracks the broader market through more than 500 of the biggest companies out there, with the top 10 largest holdings making up over 25% of the ETF, and including some of my personal favorites, stocks like Microsoft, Google, Amazon, and more. And it even pays a small dividend of about 1.6% with a tiny expense ratio of just 0.03% to own it. But I feel like this one is pretty similar to owning Berkshire Hathaway in that it's a reliable and safe place to park your money if you're a giant investor, since we all know that the market will slowly go up over time as long as the United States doesn't get like destroyed by a world war or something drastic like that. And over the past 5 years, it's up over 50%. So it's relatively stable performance, although it does have a little dip, just about 15% from the top. But I would say overall, it's a safe place to park your money. However, I have no real interest in owning it myself, since I like to handpick all of my stocks individually, and even as an ETF, I think there's more interesting ETFs out there. So I'm just going to have to rank them pretty low at number 4, just slightly behind Bank of America. and adjust all the others to fit it in. So there you have it, guys. Not a super exciting quarter in my opinion. I think there are much more exciting stocks to buy out there, but it seems like Ray just went for some safe, kind of relatively boring options this quarter, and especially bet heavy on financial stocks, which did surprise me a bit. Maybe he thinks we'll avoid a recession and interest rates will remain high, making for a good environment for them. I'm not really sure. But like I said, overall, I'm not a big fan of these options, but I went ahead and put Chase at number 1. It's the only stock I own myself, and it's the only big bank that I feel confident investing in long term, which also gives me a little diversity and exposure to that market. Then I put Berkshire at number 2 for the giant financials, the notoriety of Buffett, and the huge balance sheet that makes for a safe place to park money. But again, just too boring for me personally. Then I put Bank of America at number 3, which I think is a good alternative to JPM. But as long as JPM is here, I'm just not going to have much interest in it. Then I put the IVV ETF at number 4. Decent way to invest in the broader market, especially for beginners, but nothing too crazy. And then at number 5, I put Citigroup, which at least has a large dividend and a cheap valuation. Don't get me wrong. So I think it is okay, but everything else is just not as attractive, I would say, as the others. And it's a bit riskier too, just in my opinion. But what do you guys think? Do you agree with me that Ray's recent pickups are looking a little boring, not all that exciting? Or do you like these stocks? Or do you own any of them? I'd love to hear your thoughts down in the comment section. Let me know if you agree with my ranking as well. But with that said, that's going to wrap it up for this video. I hope you're all doing well, and I will catch you in the next one. Take care, my friends. Bye-bye.